Hello, and welcome to this I Thrive webinar series called Planning Your Exit Strategy. We hope to inspire you to plan and execute your daily business with the end in mind. And this session is called How Much is My Practice Worth? I'm Scott Jens from my executive business coaching service called Sandbox, and I'm always thrilled to serve as a moderator for this I Thrive series. I'm once again introducing today's featured expert, Dr. Mick Kling from San Diego, where he was the founder of a multi-doctor independent practice called Envision Optometry. And he's been an avid lecturer on the topics of practice management and transitions and serves in an advisory role in that way to Vision Source. He also has built a consulting business focusing on finance and optometry called The Profitable Doctor. Mick, it's a thrill to have you here.
Scott, thank you so much for having me again. I so enjoy this time that we get to spend together. And again, I appreciate you feeling the importance of this topic for us to be addressing right now for the eye care community. So really excited to dive into sort of the financial matters in and around private equity and some of the things that they look for and what we need to be thinking about from a valuation standpoint for our own practices.
Well, the I Thrive community is really lucky to have you here. You become a preeminent expert or a master of information on this topic through all the sessions that you've been giving over the country. And so today we get you on our own, and let's jump in. This idea of how much my practice is worth is going to help you listeners get a step-by-step guide to how eye care businesses are valued today. We're going to focus on the numbers of practice exit, and I can't wait to dig in. So let's get to it. Mick, through your teachings at The Profitable Doctor, you have consistently told doctors focus on cash flow. Whether they're in a practice transition or not, I'd really love for you to expand on that and give us an understanding of why it's so important.
Yeah, one of the things that I learned in my own practice is that we can look at all kinds of reports and all kinds of metrics and all kinds of tools that we have in and around understanding our practice. But at the end of the day, what really matters and what is the fuel that keeps our business strong is cash flow. So just like a runner who's running a marathon, it's like the goo or it's the water, it's what keeps us going. It's the breath, it's the oxygen that our businesses need. And so when companies like private equity firms look at a business, their primary focus is what is the cash flow of the business, because that's where they see the value lies. It's not in revenue. It's not even in profit, because profit is very misunderstood accounting term sometimes, because profit doesn't guarantee cash flow. So really this idea of understanding what is cash flow, why is timing of cash flow so important, and why does private equity care so much about the cash flow of my practice is really what I'd love to dig into with you today.
So let's hit that just a little bit more deeply. I know that profit is sort of an accounting-based calculation of whether I made money at the end of the year against the expenses that went against my revenue. But there are times I know as a practice owner where sometimes our cash got low. We were going to have a hard time making payroll maybe at the beginning of the month. What is that tidbit on cash flow that you can give us as sort of this main offering before we get deeper into practice valuation that you tell every OD they should understand?
Yeah, cash flow and profit are different. And so here's why. Profit is an accounting term that our accountants use to determine how much our tax liability is, right? So we have income that comes in and we have expenses that offset or that we've incurred to generate that revenue, and what's left is called profit. That's what our tax liability is based on. What that profit and loss statement does not take into consideration are two very important things. One of them is distributions that the owner might take out of the practice, because that's cash taken out of the business, but it's taken out of profit. And if you borrow money to buy equipment, it's the principal payment for that equipment. So for instance, you can deduct the interest expenses as an operating expense, but the principal payment that you make for that equipment has to be paid for out of the profitability of the company. That's also a true cash expense. So you can have profit on one hand, on paper, but no cash. That's why we get these surprises from our CPA at the end of the year that says, hey, Doc, I'm so proud of you. You had a profitable year. You pull out your cell phone and look at your bank balance and there's no money. You say, how can I be profitable, but I've got no cash? It's because we've got to remember that cash spends differently than the profit that lands on the bottom of our P&L.
That's tremendous. Thank you for that. So before an OD considers who might be a buyer for their practice, he or she has to think about the practice life cycle. There needs to be, I think, more of a conscious thought about transition timelines, regardless of your age. Why don't you help us understand what a doctor should be thinking about?
The timeline is probably the most important thing that we want to consider in this situation. If you have a short horizon, let's say 5 years or less, and you've decided I'm going to be out of this business in 5 years or less, having a conversation with private equity starts to make sense, because essentially what you're doing is being paid in advance for 5 years worth of your future earnings, essentially, is one way to look at it. If your horizon is 5 years to, let's say, 10 years, that becomes a little murkier, because what happens is in that next 5-year window, from year 5 to year 10, the amount of money that you could earn as a business owner starts to exceed what you could earn as an employee of a private equity firm. And at the end of that 10 years, you still have the asset. You still own the asset that you could potentially sell. When you get beyond 10 years toward 15 and even 20 years, just purely from a financial standpoint, it really doesn't make a lot of sense to sell your practice unless for personal reasons, just operationally, you've had enough and you just feel like you need to be out. But that 5-year window is, I think, what's really attracted a lot of sellers right now that have not been thinking about their exit strategy, maybe haven't planned their personal finances in the right way, and they're thinking, I better get out now when I can get a good valuation for my practice. But if you got beyond 5 years, it really, from a financial standpoint, does not make a lot of sense for most practices.
That's really interesting. So as a follow-up, there's no right or wrong answer. But if I'm 15 years from what I think is a good age to think about transitioning my practice, and I've been really successful in the first 5 or 10 years, would I just as likely want to keep my mind open to what could happen within a 5-year window from a buyer like a private equity buyer? Or do I keep my head down and just drive for 15 years? Is it that simple?
Yeah, I think this is where it gets personal. This is where all the personal influences have to be considered as well. It's not just a financial piece. If you look at it just financially, the answer is don't sell your practice, because it just mathematically, and I'll show you in a few minutes how that sort of works out mathematically.
Okay.
But there are often all the other personal things, like I just want to be the doctor, or I'm having some health issues and I need to make sure that my wife doesn't get stuck with this practice and have to do something with it. So there are many other considerations, just financial, but the timeline is most easily illustrated if you just think about it from a financial perspective.
That's really good. Okay, so let's advance through some slides that'll illustrate some of these financial matters, because you really have a great setup for us to look at.
Perfect, Scott. Thank you for getting this up here for us. So let's, I want to talk a little bit about valuation and how private equity firms are valuing businesses, including eye care businesses. You've probably heard the term EBITDA before, and EBITDA is an acronym which stands for earnings before interest, taxes, depreciation, and amortization. So let's break that down a little bit, because I want you to understand what that means. So earnings are what the company, what your business earned before we take into consideration the interest that we pay on the debt that we have. In other words, if we borrow money for equipment, interest is a deduction, and we don't consider that. So it's the earnings before interest. It's before we take into consideration the taxes that we owe on the business. It's before we take into consideration something called depreciation, and before we consider something called amortization. So let's break these down a little bit more clearly. Interest, we talked about, is what the cost of borrowing money. The IRS allows you to deduct interest as an operating expense. If I'm a seller and you're a seller and I have no debt and you have a ton of debt, you're going to have a higher interest deduction. So considering the valuation of our two businesses and excluding interest, makes it a little bit more level playing field. What EBITDA does is makes it easier to compare two businesses because we remove the fact that I might have no debt and you have a lot of debt. The same with taxes. The taxes that we pay, hate to say it, believe it or not, basically are an opinion of our CPA. And what I mean by that is if you give your financial data to 5 different CPAs, you're likely to come out with 5 different tax liabilities. And the reason that is our CPAs have some wiggle room as to how they decide to interpret our finances. Some are more aggressive, some are more conservative. All of that impacts the tax liability for your business. So again, maybe I have a very aggressive CPA that's doing some things to lower my tax obligation, and maybe you have a CPA that is very conservative and you have a higher tax liability. By removing the valuation of what we pay in taxes, it again equals the playing field. Depreciation and amortization in accounting are 2 expenses that are considered non-cash expenses. And what that means is I don't really pay cash money for depreciation or amortization, but they're expenses that I get to use to write off against the operations of my business. Depreciation is taking the value of a tangible asset and taking a portion of that and expensing it over time. For instance, if I buy a $50,000 OCT and I depreciate it over 5 years, that means every year I get to deduct $10,000 as an operating expense, as if that piece of technology were losing value over time. Amortization has 2 meanings in accounting. And in this meaning, it means the same as depreciation, but it's for non-tangible assets. So things like, intellectual property, things like software licenses that may not be easy to put your finger on. In eye care, amortization is generally not a very big expense, but we do see that pop up from time to time. Again, because my debt structure could be different than your debt structure, my depreciation could be different than yours. Maybe my CPA takes Section 179 and takes the entire depreciation in 1 year, and your CPA recommends that you take depreciation over multiple years. Again, it's an example of how our accountants can handle our finances differently, and all that can impact the bottom line of our business. That is a long way to explain why EBITDA is the earnings before we take into consideration interest, taxes, depreciation, and amortization.
Hey,
Scotty,
Mick, so let me see if I'm being a good student here. My earnings is essentially a proxy for the word profit to begin, because I take my revenue and subtract my operating expenses, my staff and my rent and other things. And I get this earnings bucket, but for tax purposes, EBITDA levels the playing field and allows you to compare different practices on a type of a profit basis, but it's called EBITDA.
That's correct. That's correct. Because we're we're stripping out things that might be different for you than the way I run my practice. Maybe you have a philosophy where I don't want to borrow any money, therefore I don't have any interest payments, and I have no depreciation, and I'm super aggressive on the way I want my CPA to tackle my taxes. That's a different outcome than an individual who has a practice that borrows a lot, has a lot of interest payments, a lot of depreciation, and affects how ultimately the taxes are paid in the practice. So it levels the playing field when looking at 2 different businesses. Because you think about a private equity firm that's looking at 10 practices at one time, how do they decide if 2 $1 million revenue generating practices should be valued the same? And then the old methods of valuation, when we would just say, oh, your practice is worth 65% of revenue, well, we might have 2 $1 million practices that one has a 10% net profit and one has a 30% net profit. We easily can see that those practices are worth different amounts. We wouldn't just apply this generic 65% of revenue valuation. So it tries to take into consideration some of the variables that we as business owners kind of apply to the way we manage our business.
Okay.
If you want to go ahead and advance there. So let's look at this kind of broken down in a little bit more of a math formula. So if we think about sort of how a profit and loss statement is generated, we have income, and what comes off of that income, we have expenses, and we often look at our expenses in cost of goods sold. So our frames and lenses and contact lenses that we sell are one bucket of expenses, and then we have just the overall operating expenses of the business. Those are our occupancy costs, the things that we call place, and our people costs, which is all of our payroll and related expenses, and all of the other fixed operating expenses of the practice. What comes out at the bottom of that is something called our net operating income. And if you've ever looked at a profit and loss statement, that's the line that appears in bold often, but that does not take into consideration what we pay ourselves as far as the doctors in the form of salaries, whether that be a W-2 wage or a distribution that we might take out of the practice if assuming we're a practice owner. When you calculate EBITDA, there's one other really important part of the equation that we need to consider, and that's something called owner addbacks. And what comes out off of this net operating income is the doctor's salary, but what gets added back to that net operating income are these so-called addbacks. So what are owner addbacks? In this example, this $1 million practice, we've got expenses, which result in net operating income. We then subtract out the doctor's salaries, fair market wage for what a doctor would cost us to operate the practice, see the patients. We've now stripped out all of the add-backs, all the things that were buried in the practice, either intentionally or unintentionally, and then we get this resultant EBITDA number. That number then is applied, has a multiplier applied to it, not a percentage, but a multiplier, and the multiples are ranging anywhere from about 5 to 7%. So in this example, with an EBITDA of 175,000, if you apply the range of a 5 times multiple up to a 7 times multiple, you would see a valuation on this $1 million practice anywhere in the range from 875,000 all the way up to 1.25 million for this practice. And as you can see there, Scott, that's quite a bit of a higher valuation than what you might be familiar with a traditional practice being valued at. And that therein lies one of the real big appeals to these private equity acquisitions, is that in these models, in these formulas, they're willing to pay more for the practices. So let's talk a little bit about these add-backs. I think it's important to think about like what some of these are. There are at any given moment a number of things that you might be running through your business legitimately and legally that are valid tax deductions, because remember, we pay our CPAs to do two things. One is to file our tax returns, and two, to make sure we pay as little legally in taxes as we possibly can. And so because of that, we are building some expenses within our business that reduce the profitability in our practice, because that reduces our profitability and therefore our tax liability. When we do this, when we bury these expenses like trips to Costco or running our expensive BMW through the practice, we're lowering the profitability on the practice, which is good because we're lowering our tax liability. But the acquiring entity is not going to lease that expensive BMW. They're not going to take grandma to Hawaii for, quote, CE. They're not going to buy an expensive bottle of wine at a, quote, work dinner. So they are allowing us to add those expenses back into the valuation formula, and that actually helps us. And one of the really powerful things about add-backs is if you have a 6 times multiple for every $1 that you can find in add-back, that yields you a $6 increase in valuation of your business. So obviously, when you're going through this exercise, you want to work really hard at finding every little add-back that the buyer is willing to allow you to build into the model, because that can yield a very large return in valuation on the practice. Want to go ahead and advance for us, Scott? Let's talk a minute about adjustments to EBITDA. This is something that is very commonly seen as well. There are two primary areas that adjustments to this EBITDA number can occur, and one of them is in the OD compensation side of things. You know, I look at a lot of practices, and it's very common for practice owners to either overpay themselves or underpay themselves. They either overpay themselves because they're using their business bank account as an ATM machine, and they build a personal lifestyle that is more than they can sustain their business can sustain, or they're underpaying themselves because they have cash flow problems and they can't afford to pay themselves a fair market wage. When private equity comes in, they are going to look at your business and they're going to model it in a way that considers what it would truly cost them to go hire an OD to do exactly the same job that you're doing. And in this example, I simply applied a PE compensation model of 15%. What that means is that private equity would say, okay, doctor, you generated $1 million in revenue. We're willing to pay you 15% of collections, or $150,000. But we noticed that you're only paying yourself $125,000 on your profit and loss statement. And so we're going to reduce your EBITDA number by $25,000 because it's going to cost us more to hire somebody at fair market wage than what you've actually been paying yourself. So that's an example of a negative impact to the EBITDA number. Now, on the flip side, if you own your own real estate, sometimes our accountants might be having our real estate held in a separate business entity, and our corporations, if you're an S corporation, might be paying rent to your real estate company, and your CPA might have you be paying higher than fair market rent because of tax benefits to doing that. And so therefore, your profitability of your business is reduced because you're essentially overpaying in rent for tax reasons. If the private equity company comes in and buys your practice, they will likely retain your location and become your tenant if you own the real estate. They will then pay you fair market rent. They're not going to pay you what you've been paying yourself if you've been overpaying yourself, but they're going to do a fair market analysis and they're going to pay you fair market rent. If you've been overpaying yourself for rent, and they come in and pay you fair market rent, your profitability or your EBITDA just went up. And that's a positive impact on your EBITDA number. So in the first example, the doctor was undercompensating him or herself, and it resulted in a negative impact on EBITDA. In the real estate example, you're overpaying in rent. Now that we're paying fair market rent, we have a positive impact to EBITDA. And Scott, I know we're getting into a little bit of the weeds here and a little bit more math, and there's probably some eyes that they're glassing over right now. But I only wanted to share that because I think that's such an important part of understanding why they would come back at you and say, we need to make an adjustment to EBITDA based on this particular circumstance. So let's talk a little bit about this multiple. We talked about this 5 to 7 times multiple. What are some of the things that influence it? Well, there are all kinds of things that influence that number. Some of it is market demand, competition. If you've got other private equity companies looking at you, it's possible that they could be competing against each other for what they're willing to pay for you. Location is really a big one. If they are really looking for a very strategic market, they might be willing to make a bigger investment in that number. If you've allowed your practice to dwindle, let's say the aesthetics have started to slip a little bit on you, maybe you're letting the carpet get out of shape, or maybe you've got the same mauve carpet since the 1980s, and they're seeing that they have to come in and make a large capital investment to get the practice up to where they think is a appropriate level for presentation purposes, that actually might negatively influence your multiple. So there's just a number of things that are going to influence what they're willing to pay for your practice on that multiple. The EBITDA is the EBITDA. The EBITDA number is a mathematical formula. The multiple number can be negotiated and can be influenced by all of these different factors. So I wanted to just share a little bit about what's changed since COVID. You know, I mentioned, I don't remember if it was in this presentation or the first one we did, that this market is changing so fast. I literally have to update my slide deck about once a week. But I just wanted to share a couple of things that have happened since COVID. You know, obviously, all of our practices have been somewhat impacted since COVID. Most of us had to shut down for a month, or some of us even longer, and that really hurt our revenue numbers. What the private equity companies are typically doing now is they're looking at data from early 19 through early 20, and not considering the post-March of 2020 financial data that you have, because they understand we all suffered a very significant dip in our revenue. And so to look at trailing 12 months of data from today, meaning what's happened in the last 12 months from today's date, is not going to be a very fair reflection of historically where our practice has been. It's a true number of what really happened to your practice, but we can argue as sellers that, you know what, this is pretty unusual circumstances, and this is a ding against my practice that I really had very little or no control over. And so there's been some things that they've taken into consideration. One of them is the timeline and the date period of when they're looking at your practice. The other thing that they're doing is they're holding back greater amounts of the acquisition price. Now, it's been very common for them to have 10% of the holdbacks for something called representations and warranties, which means that there are all kinds of things that you might say as a seller that may or may not be true. Not suggesting you're not being honest, but what I mean is maybe there were some things that you thought would come to fruition that didn't, and so they often will hold back a 10% of the sale price just to reconcile any of those things that could occur, with the idea of within the next 12 to 18 months paying that balance that's due to you. So while that 10% holdback has been common, those holdbacks have now been turned into what are called earnouts, and those can be all the way up to 20% or potentially more over the next 12 to 36 months, which means if you can prove that your practice recovers to pre-COVID levels, then the valuation numbers will then be honored to pre-COVID valuation. So there's sometimes these catch-up payments that they'll do over time, but they have to be contingent on your practice recovering. And if your practice never recovers from COVID, then the private equity firm can say, well, listen, we can't honor that valuation number we gave you because your practice hasn't proven itself that it's going to recover. The recovery period, they're generally pretty generous and will give you a couple of years to recover. So I believe they're being fair about us recovering from COVID. But just understand there are some catches in some of the contracts that have these recovery clauses in there. And then the last couple of things that I'll mention is that I've seen contracts that address the PPP loan. In particular, if you took out a PPP loan, are you going to make sure that you're going to have that loan forgiven? And if it's not forgiven, how might that impact the transaction? The buyer, the PE firm, is not going to necessarily assume any PPP loan portion that is unforgiven. So I'm starting to see language that is addressing what happens to the PPP loan. And in that case, also the EIDL loan, the EIDL, if you were able to get the EIDL loan as well. So I just wanted to touch on those big topics in and around COVID. Again, just understand this is an evolving topic, an evolving conversation. But that's where we are since COVID, Scott. I want to just take a little bit of a step back and talk about this timeline piece. And just as we wrap up this valuation conversation, talk a little bit about and show you an example of two scenarios of one selling the practice and the other one not selling. And I know this is a really super busy slide with lots of numbers, and but here's what I want you to take out of this. everything above the black line assumes that we do not sell this $1 million practice. Everything below the line assumes that we do sell it. And I took this scenario and said, okay, if we don't sell, we're going to have a certain amount of expected growth over 10 years. If we do sell and we take our proceeds off the table and we invest the proceeds and got some sort of modest return on investment, where would we look? And my only point in this slide, and please understand this is certainly for illustration purposes only, but at 5 years, we see that tipping point where financially it starts to make a lot more sense to hang on to your practice. Remembering too that at the end of that 10-year term in this example, you still own the asset to sell. So if we add the value of the asset on top of what the earning potential and after-tax income of this practice would be, it far exceeds what you would earn if you were to sell that practice over this 10-year horizon. So I simply wanted to include this to remind everybody that horizon really is such a critical part of this. And I believe this is our last slide. And I just wanted to wrap up here and show this example. This is a slide that I pulled out of one of my cash flow talks that I have. And it talks about something called the power of one. And the illustration here is in a relatively average size practice. So not a practice that necessarily private equity would be interested in, because if you remember, they're looking for practices that are $1 million and more. But in a pretty average practice, if you increase your revenue by 1%, by just being better at selling the things that we sell, if you increase your fees by 1%, let's say you just make minor incremental fee increases that most of our patients would never even notice. If you decrease your cost of goods by 1% and decrease your operating expenses by 1%, you're going to move the EBITDA of this practice in this example from 80,000 to over 108,000. So it's a small little $28,000 EBITDA movement. But what I want you to look down at the bottom where the arrows are, if we apply a mere 4 times multiple to this example, we increase the value of this practice from 320,000 to 435,000, or $115,000 increase in value. If you then look at a 6 times multiple in the example, we move the value of this practice from 480 to 652, or $172,000 increase in value. The reason I wanted to point this out is small little incremental improvements in your metrics, 1% movements, can yield enormous improvements in your cash flow. So whether you're selling your practice to equity and that results in an increased valuation on the sale price, or whether you're just improving your own cash flow of your business to sell it at a later date, these small incremental movements, this concept of the power of 1% movements in these metrics can yield some enormous improvements in the cash flow and therefore the valuation of your business. So Scott, that does it for the slide deck and the examples that I wanted to show you. So thank you for letting us go through those.
Yeah, absolutely, Mick. That's really powerful. You talk about the power of one, but it's really the power of one times the valuation multiple. And so, boy, what a great illustration. So as we get toward the end of this presentation, let's talk about some of the considerations a doctor needs to make before selling. Wrap it up for us.
We spent a lot of our time talking about the financial aspects of our business. We talked about valuation and how we determine multiples and those sort of things. But I think when I really came down, if I can just reflect personally on my own decision, there were many things besides the financial. And we talked a little bit about the personal influences that occur as well. But I think as I sort of encapsulated it for myself, some of the biggest decision-making things that were impacting me were, one, is this going to meet my financial goals? Is this going to get me across the finish line to where I need to be personally from a financial standpoint? Am I going to be able to work for somebody else? That was a very big part of this. How is it going to impact my culture within my practice? Because I know that change in leadership results in change in culture. And how do I feel about my legacy? And how about my trust level with these new partners? If I know they're going to flip this business potentially to somebody else in a few years, what is my level of trust? And of course, how's it going to impact my staff? So I think the take-home message is we really need to, in the decision-making process, not just look at the finances and the valuation piece, but really think about how this is going to impact all of the other things that are going to potentially affect you from a personal level, from a team culture level, from a personal family level. All those things need to be taken into really great consideration when you're deciding what to do.
So there's been some great hanging in there that people have done through this process, and they've gotten a lot of info. Let me hit a couple of very quick hitters, but are very impactful ones. You started by talking about FOMO, that there might be a fear of missing out if I don't go now. Can you give us a general sense of how long private equity acquisitions will be available?
I will tell you, 2 years ago, I had FOMO. Here I am 2 years later, seeing the highest valuations that we've seen ever in a COVID crisis. Okay. So my feeling is this is not going to go away for a while. If you look at other industries, dentistry, veterinary medicine as examples, we typically see that about 20% of the market gets acquired by an equity model. And I don't know the exact numbers today. I knew them about 6 months ago, so I don't want to quote them today. But if I were to use a very ballpark number, there's probably been less than 2,000 private equity acquisitions in the last couple of years. Don't hold me to that. Could be north of that, could be south of that. There are over 20,000 independent practices in the country. So certainly less than 10%, I would suggest, have been acquired by private equity. So I think we've still got a long way to go in this conversation, and that market is going to continue to stay hot for a while. And so we've got some time. The last thing you want to do is make a hasty decision because of FOMO and then end up making a decision that you look back and wish you had not made.
One more. There's a lot of optometry students that are going to be coming out in the next few years. Is this a place for them to start their careers? Are doctors who decide to stay an independent path going to find just as many optometry students that want to go into their sort of setting?
This is really the impact for optometry students is really a significant one because students are coming out with so much debt. The cost of education is so high now, they're looking for stability. These companies are offering much more attractive employment opportunities than what independent practice has been able to offer, because most independent practices cannot afford to just overnight go offer a full-time position. A lot of times what happens with independents is we bring an OD in 1 or 2 days a week and kind of grow them into the business. So these entities, I believe, are offering more attractive opportunities for students coming out of school. I don't have an opinion or a comment whether that's necessarily good or bad for them individually or for the profession. I just think as a matter of observation, I see that this is becoming a landing pad for a lot of new graduates. But Scott, what's really interesting about that is if you look at the data and some of the polls that are out there, a lot of these young ODs still want to be in private practice. And they see private equity as a place to go for a job with an ultimate goal of, I want to be my own boss, because I think our profession still attracts optometrists that are independent thinkers, independently minded, and have a desire to own a practice. What private equity does is simply possibly provides a starting point, because I got a lot of student loan debt and I need a job, and maybe is offering an exit strategy, but it still seems like there's a really big market that I want to own my practice in between those two bookends.
Well, Dr. Kling, the iThrive community can't thank you enough for your contribution to our knowledge. That was really well done.
I appreciate it, Scott. Again, I just want to thank you for, one, putting these series together and being so in tune to what we really need to be talking about as an industry. I appreciate you focusing the spotlight on that for us.
Sure thing. And thank you to you attendees. This iThrive webinar series is called Planning Your Exit Strategy. And we try to make every installment look like it's got value in and of itself. And today's had a lot of value. And we hope that you'll use this to plan and execute your daily business with the end in mind. Until then, be great at all you do.